Welcome to PhillipCapital's Weekly Market Watch. The US stock market faced its worst in May as it corrected about 8%, while June does not seem to head off with a good start. Today, we have Mr. Adrian Chu, CFD dealer from Phillip Securities, to tell us more. So Adrian, going forward, what should investors expect of the US economy?
Being the largest economy, investors should look at the employment situation to assess the health and the strength of its recovery. Last Friday, US has announced that the non-farm payroll added 43,000 jobs in May, less than analysts' expectations. The unemployment rate stands at 9.7%. It may not be all gloom and doom as non-farm payrolls figures are rising for the past 3 months. Unemployment rate remains contained and well below 10%. Therefore, I believe that the US economy is on track to a gradual recovery.
There are talks about the European country debt issue which will derail the fragile economic recovery in the US. What are your views?
In short term, I believe the US market is still pretty bearish as nearly half of the S&P 500 companies are dependent on business out of US. In addition, more than 22 million American jobs, equating 2 out of 10 workers, are linked to foreign trades. Furthermore, about 15% of the US equities are owned by foreigners. Thus, these figures reveal the double edge of globalization as the risk of a sell-off by these foreign investors at times of crisis. But one advantage that Americans possess is flexibility, as the unemployed are able to move between states to seek for jobs while the EU cannot. To say, the Greek cannot just pack up and move to France to look for employment.
Having highlighted all these points in the US, what is your advice to investors in the recent weeks to come?
By looking back in history, what we are experiencing in Europe is not something new. Some example would be the devaluation of the peso by Mexico in 1994. In 1997, the Thai baht crashed and spreads to Malaysia, Indonesia, and South Korea. Russia defaulted on its debt in 1998, and this event caused the US market to plunge, and many wondered if Russia could survive. Recently, Argentina suspended its debt payment and closed off its bank in 2001, and each event sparked off a sell-off in the US market. However, the market recovered on the average of 17% in a year. Letting history be the judge, investors should buy into the market and into top quality stocks when fear is in the air and when it seems that the world is coming to an end. A good gauge of fear would be the commonly used VIX index. For traders, they might want to explore trading on these economic indicators with ETF or CFD that tracks a broad-based US or global indices.
Thank you, Adrian. That's all we have for you today. Tune in next week for more market updates.